before we continue, first, can you give me your take and your opinion and what you understand about velocity banking? And then let's talk about, after that, we'll then transition to how can we use a first position HELOC to practice velocity banking?
Absolutely. No, thank you. I don't know if I can, I'll give you my understanding,
Okay.
and we can go from there. So I mentioned earlier that really all this is, we can call it velocity banking. There are different terms for it, right? And for the same strategy, right? For the same way of using this loan, right? Or using an open-ended line of credit. And all it is working within the rules of the loan, right? And optimizing how these rules work. That's it. And we can make it out to be some big new thing, right? Which it kind of is to a lot of people, right? Which it really is to a lot of people, but it's really not that new, and it's not that complicated. It's pretty interesting. So we know this loan is an open-ended line of credit, right? And we know that it calculates its interest using the daily principal balance, the average of the past month's balances, right? Each day. So if we start with the average principal balance, we know that we can manipulate the average, right? We know that I can create a high average or I can create a low average, right? Well, if we want to create the lowest interest cost at the end of that month, we want to create the lowest average. So what that means is, in order to create the lowest average, we need to create the lowest balance as quickly as we possibly can and maintain the lowest balance for the longest period of time. That's what creates the lowest average. So that actually leads into the first part of this velocity banking strategy, which is we want to create the lowest balance, which means that we need to take everything that we possibly have in real time and get it into the HELOC as quickly as possible as a principal reduction. I sometimes even call it a principal payment, right? You can call it that, because if we're thinking about a mortgage, that's your principal payment, because everything you have goes into the HELOC. So what people do is, when they get paid, they deposit all their income into the HELOC. That creates the lowest balance possible, right? And then, now, if we think about doing that, most people think that sounds kind of crazy, because if you were to do that with your mortgage, your money's gone and then you can't eat.
It's locked up, it's gone,
right? So you can't do that with a mortgage, but here you can safely, because remember, this is an open-ended loan, which means you can take money back out. And so that's exactly what you do, right? Throughout the month, you borrow back against your HELOC to pay your bills, right? You borrow to buy food for your family, to pay your auto loan, right? So, and then at the end of the month, what you've done, if you think about the cycle, is you've created a massive decrease in your balance with all of your income that you have. So you don't put it in your checking account, you put it in your HELOC. Decreases your balance on your HELOC, and then you borrow back against your HELOC to pay your bills. And at the end of the month, whatever's left in there from that principal payment, right, from your income, whatever you have not spent, that is what serves as your principal reduction for that month. So the whole idea here is that, is that when you make a whole lot more than you spend, right? When you cash flow well, right? If you can create a scenario, if you don't cash flow well now, if you can create a scenario sometimes with debt reduction or debt consolidation, you can create a scenario where you do cash flow, right? So if you cash flow, what that means is you do have that large decrease in principal reduction with your income and a small increase with your expenses, which means you still have a lot of money left in there. So all in all, what this strategy allows for you to do is it allows for you to use and leverage every single dollar in real time that you don't use to pay down your home loan. That's all this is. Money, all your money goes in, and then whatever you spend money on goes out. Money goes in, and whatever you spend money goes out.
So we have a checking account, and it's real time. It's pulling from the HELOC instantly. We're checking our. Do you also get a debit card?
You do. Absolutely.
You do. Wow. Yeah. So you can actually use the checking. Write a check, or you can pay a vendor with a debit card.
Absolutely.
Just like you would a regular checking account.
Debit card, checks. An online dashboard with online banking. It has online bill pay, ACH, which is outbound online bill pay from our system, right, where you create vendors. There's ACA as well, because it has a routing account number. ACA is where your credit cards and your credit cards and utilities, they attach to your routing and account number, and they do the auto pay through their system, right?
Oh, nice.
So that two different
It's going
options.
seamless.
That also means you can use things like PayPal, Venmo, Zelle. It has a mobile app with mobile check deposits, so you can manage everything through your phone. So it's a regular checking account with all the features you'd expect. The main difference is that it's connected to your HELOC, and when you deposit to this checking account, that night it pushes the money into your HELOC, reducing your balance. And when you spend money with the checking, that night it pulls money from the HELOC to increase your HELOC's balance. And the reason why we've built it this way, it's not by coincidence, it's more by experience. My boss, his name is Roger Williams, he brought the product to the bank, and he's been working with first lien HELOCs since about 2014. Okay. So in general, and he's worked with other first lien HELOCs when people were trying to do velocity banking. And what he found was that with most first lien HELOCs, where it requires that transfer of funds between each account, that what that means is if you're going to get money into the HELOC, every single time you need to get it in, you direct deposit to your checking, and then you have to log in and transfer funds.
Right. And
then every time you want to spend a dime, whether it's a haircut or going to, get groceries, or your auto, even auto pays, that kind of stuff, you have to log in and transfer money from your HELOC back into your checking.
Right.
And, when this works, we do a lot of work up front to make sure that the numbers work here. When this works and people are using it in the way that they should, what we found is when the HELOCs work like that, in the regular, I guess, more traditional way of having it be a separate account.
Right.
The reality is that you have to transfer funds for every transaction that you're going to do.
Right.
For the remainder of your loan. And even if you're paying off your home really quickly, say 5, 7 years, 8 years, that's a long time. And we learned that responsibility is a much greater burden than what people usually anticipate. And it's actually the main reason when people are trying to do velocity banking that they stop, or they quit, or they fail. So we built it this way in particular for people that want to use velocity banking to address what we learned to be the main cause of failure, because we don't want our product to get in the way of people's success. Awesome. Right? We want to make sure that there's a seamless transition between what people do now without the strategy and without the HELOC and with it. So that way it's really just up to you and your budget.
So you and your team and your bank are pro velocity banking, from what I'm hearing. Your product supports it. You guys support it. Do you offer or provide any actual customer service or support to clients who may have questions on how they may practice velocity banking with this product?
Absolutely. Yes. Absolutely. So although I'm a loan originator, and I guess you can call me a banker, a lot of times your loan originators, they have one function. It's just to get someone into a loan and then it's next, right? We take the understand, what we assume the understanding that and we understand that this concept is not well known. I know what it sounds like. It's like, hey, guess what? I've got this loan you've never heard of, and you can pay off your home in 7 years. And by the way, you can save $100,000 in interest, and you don't have to change your budget. And by the way, the rate doesn't really matter that much. It sounds too good to be true. The reality is it doesn't work for everybody, right? It's not a fix-all for everyone. It's not true for everyone, because you have to cash flow well for this to work. But when this works, what we find is it is really successful. And the skepticism really comes from a lack, or not a lack of understanding, I guess lack of understanding, but even more a need of education. So people can understand, here's how this loan works. Here's why it can work. Here's what it looks like for you. Right. And so we take a really heavy educational approach on the front end. This is, at least in terms of our bank branch here, or our mortgage branch here at First Savings Bank, this is pretty much all that we do. I may have one conventional investment property mortgage. We do have access to the other loans that the bank offers, the mortgage unit offers. But our branch here specifically focuses on first lien HELOCs and education and support of that, and helping people get into this product when it makes sense, right? When it's the best option for them.
Incredible.
And so in terms of support, we have the front end education. This is all that we do. So every single person that touches our loans, this is what they specialize in, from although he doesn't touch the loans, to Roger, right, who built the product, who brought it here, to our loan origination team, right? We have different loan originators. All they do is specialize in understanding, knowing this, and helping other people do the same. And to our processors, to our first lien HELOC underwriters, to our first lien HELOC closers, even to the people on the retail side of the bank who manage this particular checking account. Everyone here knows and understands what our customers are trying to do and what the product is about. And so we do hold these loans in-house, and so they're on our balance sheet, and we service them ourselves. So when, if people have questions on the back end, which actually luckily doesn't happen too often, which tells me they're getting kind of what they expect, which is great. But when they have questions, and it's about their checking account, right? Well, I don't work on the retail side of the bank, but I do know who does. And so when they call me, if I'm their point of contact, or they feel more comfortable reaching out to me, I just put them in touch with the people on the retail side that manage this particular thing, right, to help them answer that, and vice versa. When people have questions about the strategy, right, or about how the first lien HELOC works in particular, and they reach out to the retail side, what they'll do is they'll say, hey, Anthony is probably the best person to talk to, right? Why don't you get in touch with him? And then, so from a different level of support, that's really, I think, one thing that makes us different here is because this product requires that. And what we're hoping to do is meet the need and help people understand, know what this is, know it well enough so I'm not convincing you that it makes sense. That's not what we want to do. What we want to do is help you understand and then decide on your own, because you have such a high level of understanding that the pros and cons, right? The pitfalls, the things that work, but you also, if you decide to do this, are doing that because you have a full understanding of why it would make sense for you and what your plan is.
Excellent. Thank you so much.
Yep.
So let's talk about who qualifies and how, what it takes to qualify. Maybe just give me some of the minimum expectations or requirements for an applicant.
Yep. So if we're talking about just qualifying for the loan itself, guidelines, for the best terms, you're going to want to have over a 700 credit score. We can go down to 660, but the terms in terms of qualifying, it becomes less likely at that point. So the debt to income it decreases, which makes it harder to qualify. The loan to value decreases as well. So you're really going to want to shoot for a 700 or above, even though we can go lower. We can go to a 45% debt to income, which I can go into the debt to income calc, but right now, the whole idea is you've got your income, and then you've got your current debt, and then we have the housing expense, the anticipated housing expense that we calculate from having this loan. And your debts, right, can't go, all those debts can't go over 45% of the calculated income that we have.
Right.
That's about as far as I think it would make sense for me to go into, just because other than that, we get in the weeds but so 45% debt to income. What I usually say, I name that because it is a guideline, but my rule of thumb in terms of debt to income is we don't know until we know. I think that there's a lot of media out there and loan officers and ideas, right, that we can call someone or type in some numbers in an app and they will tell us what our debt to income is in 5 minutes, and then we're good to go. I don't believe that's good practice. At least that's been my experience. So it takes more than that. So in terms of the debt to income piece, my whole thing is we just don't know until we know, but that is one of our guidelines. For any sort of derogatory mark, mainly bankruptcy, foreclosure, short sale, we need to have 4 years after the expiration, timeline in order to be able to do the first lien HELOC. The minimum line amount, the minimum draw, right? So your minimum balance needs to be $100,000 And so we can't, right now, our guidelines don't allow for me to do a first lien HELOC if you owe $30,000 on your house, right? We have to get to that 100,000 or higher. We can go from 100,000 up to a line amount of 1.5 million. And so that's sort of our range. And
So
we
before you
go,
continue, so just to clarify that, so someone has a $500,000 property, they only have $50,000 of equity.
Yep.
They won't be able to refinance that until they have 100,000 of equity. Is that what I understood you're saying?
Good question. So let me clarify.
Okay.
So if we have a $500,000 property, if you owe $30,000, somehow we have to borrow $70,000 more. We usually do that with debt consolidations to either pay off other debts or other properties, right? So if you owe $30,000, your balance on this HELOC when we paid it off would be $30,000. We need the balance to be $100,000 or higher.
Okay.
Does that make sense? And we call that the draw, right? I would equate the word draw to balance, right?
Of mortgage.
So, right, of the
Okay,
mortgage,
so let me ask that question again, because I think you answered it correctly, but not directly. So
yeah, exactly.
Yeah. So if two scenarios, I have a $500,000 asset, market value. I owe 450,000, and then I have another same scenario, $500,000 asset, but I only owe 50,000.
Understood.
Okay. So talk to me about the two scenarios.
Okay. So if we're gonna talk about the draw, right, or the limit, right? The scenario, the second scenario you talked about, where you have a $500,000 property and you owe 50,000, right? That would mean that when we paid off your mortgage, the new balance on your HELOC would be 50,000. Our guidelines require that the balance that we start with is 100.
Is 100. Okay, I understand.
Right. So that's what I mean by we have a minimum minimum draw amount of 100,000. There are ways around that. So for instance, when people have debts to pay off or other properties they need to pay off, we can loop that in. We can use the HELOC.
Okay, so that's pretty awesome. So wait. So what I'm hearing now is, okay, I don't meet that minimum 100,000, but I have a $30,000 car loan and I have $20,000 credit card debt. Yep. So to reach that 100,000, we can go ahead and pay off those debts to have a $100,000 balance inside of the HELOC, so that we can then qualify for the full $500,000 refi into the first position.
Exactly. And the more that people learn about velocity banking and the different ways to use it, what you'll find is that this is one of the best debt consolidation tools you can find that I know about.
Wow. That's pretty awesome. So this is a solution to a debt problem before even getting the product. Just to even qualify for the product, it could help eliminate debt right away.
It can help eliminate debt. It can help increase cash flow. Wow. And velocity banking, and I'm sure that a lot of your market and the people that listen to you probably have a good idea about what's most important here, and cash flow is most important. This only works with cash flow. So if you can increase cash flow, it actually helps increase the aggression by which this gets paid off. So It's not like we're making a sacrifice to make the loan work. We're actually doing best practice to allow for the loan to work as well, which is really amazing.
So now if I'm looking at a new property, a new asset, I don't own anything yet. I want to buy a new home. Maybe my first time, maybe my second or third, whatever. How far can we go into doing consolidation at that time? Or are we simply going to focus on the asset only?
So in that, with a purchase, the way that loan is structured is it doesn't allow for the debt consolidation to be part of that picture.
I didn't think so, but that's why I wanted to ask.
No, absolutely. You're right. And I'm glad you asked, because a purchase is a little bit different than a refi. If we're talking about, and I use the word refi as in terms of a first lien HELOC refi, right?
Right.
The first lien HELOC pays off your mortgage. Up to a $750,000 line amount.
Okay.
We can go to 90% loan to value. So what that means is, let's stick with the $500,000 valuation on your home. Our limit that we can offer would be $450,000, right? Well, with a refi, if you owe $300,000 on your house, right? We pay off your mortgage, so the HELOC's balance is also $300,000. But remember, with this first lien HELOC, our limit can go to $450,000. So when we do that refinance, you have your balance of $300,000, but you still have $150,000 up to that $450,000 in available equity to use as you want. That's where that debt consolidation can be part of the transaction, because you have the equity available.
Right.
That's different than with a purchase. With a purchase, your line amount is established, right? Your limit is established by the amount that you put down. So if you put down 10%, your limit is at 90%, and you don't have any equity above that to use to consolidate debt. Even if you choose to put 25% down, if you put 25% down with a purchase, your line amount is, remember, your line amount is established by the amount that you put down against the sales price. So your line amount is established at 75%, right? And you don't have any equity available above that to consolidate debt. So that's why it's different with a purchase. It's a really good question. I'm glad you asked.
And so now on a new purchase, if I am putting 10 or 20% down, that percentage is available instantly in the HELOC.
No, it's not.
No,
it's not.
Okay.
Yeah, no, this is great. This is really good.
Okay.
It's not because if we kind of go back to what establishes your max, what establishes your limit with a purchase, the amount that you put down against the purchase price establishes your max, which is right. And so if you choose to put 25% down, your limit is set at a 75% LTV. Your max is at 75% LTV, because with the purchase, you put 25% down. There is a way around that. I actually did this with my first lien HELOC when we purchased. I had 25% to put down, close to it. But I only put 10% down.
And then just put in a 15% after.
That's right. Because what it did is it established my line amount at the 90%, because that was purchase price minus down payment.
Yeah.
And I did have extra cash I could have used, but it didn't make sense for me to do that at that time.
Got it.
Because I wanted to still maintain liquidity with that additional cash that I chose not to put in right away. So what I did is, once we closed on the purchase, I just put it in the HELOC. So what that means is I'm still paying interest on the same balance that I would have otherwise, but I still have access to those additional funds that I chose not to put down. I maintain liquidity. And that is another one of the main sort of qualitative benefits of this particular loan, is that you maintain liquidity with funds that you put in here, right up to your limit, right? Or up to your max. You maintain liquidity, and we can't put that into a calculator. I can't figure out how much value that provides to someone. If you're never going to use it and you never want to use it, it doesn't provide that much value. But if you need it for emergency fund, if you want to invest, if you have other plans for cash, or you may have other plans for cash, that liquidity can provide an extremely high level of value that is not quantifiable at this, right now.
Got it. So I think this is a last question, and it's going to be, is this only going to be available to individuals, or can I do this under my LLC or under my business entity?
Good question. It is considered a residential loan. It's not Fannie and Freddie, because we do keep it in-house. But in terms of the definition of a residential loan, we are unable to write to an LLC. I'm unable to write to an S corp. That usually, in those scenarios, when you're writing to a company or a business entity, that's usually on the commercial side of lending. I can write to an individual, and I can write to a living trust, a revocable trust, right? Which I think it's interesting, because we can't do LLCs, but we can do revocable trust, which I get, in terms of, the understandings of what residential loans, residential mortgages, we'll call them, within that classification are allowed to do. For some reason, they've decided that that's okay. And
Right.
I'm not going to question them, but I do know that we can do that as well.
Okay.
So that is another external entity that we're able to write to.
Sure. In my opinion, that's even better.
There you go.
Yeah.
Yeah.
Awesome. Okay. So now if you would tell us a little bit about first position HELOC.
First Lien Heloc.
Would you call it is it a separate company? Is it a separate service? Can you just tell us a little
It's a
about
third party. It's a third
Okay.
party. I guess we can call it a company. Although it doesn't generate income. It's not a nonprofit.
Okay.
But it's a separate entity, right?
Okay.
And the purpose of firstlienheloc.com is to provide a free educational resource
Okay.
to people that want to learn about first lien HELOCs and about velocity banking. They call it the maximized cash flow strategy. I guess everyone has to have their little
Sure.
thumbprint, right?
Yeah.
But it's a different term for the same thing, right?
Mhm.
And it's really just optimizing how this loan works. And so, and what they do is they provide basically a free educational resource to people that want to learn about it. And then what they do is they put people in touch with lenders, with bankers, with loan officers who know the product, who have one that who have a product that aligns with what is needed to be what we believe to be successful, right?
Mhm.
Sometimes me, right? And that way it gives consumers and people that have learned about this enough through the site, right, to gauge whether they think it's a good idea for them to take a next step to learn about it.
Understand.
And ideally, they've got a calculator, they've got other resources, with the idea that with enough research, if they do a good job with teaching people about it and when it works and when it doesn't, people are able to decide for themselves whether or not it makes sense for them to take the next step to call and learn about it. And there's nothing wrong when it doesn't, when it's not a good fit, right?
Mhm. Mhm.
But ideally, it provides that education so people can get a basic idea about whether it makes sense to schedule a call. And then
Okay.
what they do is they schedule a call with one of the loan officers, one of the bankers, specialists in first lien HELOC in that particular product, who has the product, who can then help to educate even further to help people really understand, does this work for you or not, right? Is it a good idea in terms of your goals? Does it align with what you're trying to do, right?
Exactly.
And because of its flexibility and versatility in terms of a loan product, it can help in a lot of different scenarios. But that's really what firstlienheloc.com is really just an educational source for people to learn about this, sort of to advocate for this idea. It's so unknown, and there's so much value that can be provided to different people when it works. It's like this unknown diamond just in the rough that that ideally what they're trying to do is promote this idea. From what I understand, well, I do pretty much, in Australia, this is the only type of home loan that they do pretty much.
Oh, wow. Okay.
South Africa, it's very similar. From what I understand, across Europe, it's considered another type of home loan that people know about, and they choose it when it makes the most sense.
Yeah.
Right. That's really all that First Lien HELOC is trying to do is push it to the point where it can be another option, where it's not something that is completely unknown to everyone, that people know about it and we know when it works and we choose it when it works. And that's really kind of what their purpose is.
Awesome. Awesome. Well, I appreciate you coming on today, and I want to thank you and firstpositionheloc.com for allowing me to be an ambassador. And so in the
Absolutely.
link below, everyone that is watching, there will be a link so you can visit firstpositionheloc.com/the approved guy, navigate that. And then if you do want to make contact, there'll be a separate link where you can submit a request and be connected with either Anthony or someone similar with a bank that is going to be providing this unique program, the first position HELOC, that you can use for your velocity banking strategy, that you can use to eliminate debt. You can use it to just pay off your mortgage, use it to as basically infinite ways. And if you take great care of it, you'll have it available for the rest of your life. So
absolutely. Thank you so much, Sebastian. And just to piggyback really quick on, the great thing is when this works and when people opt into this tool, it does give you much more flexibility. And I would imagine that with what you do, Sebastian, with a tool like this, when it works, your options to help people grow as well improves
100%.
exponentially also. So it's one of those things where if they're working with you already or hope to or want to, I can imagine that in certain scenarios, this would be a great tool for you to be able to help them leverage this as well on the back end.
Certainly. Whether it's on the personal side for eliminating debt,
Yep.
or using the HELOC, first position HELOC for paying for college tuition or whatever the case may be, or if you're a client that's a business owner and you want to use some of that equity to start or launch your business or make some savvy investments, you're going to have the flexibility. You're going to have, remember guys, this is a line of credit that's a mortgage that has a checking and a debit account, all integrated seamlessly in real time. I mean, from what I've looked at and seen in the market as far as checking accounts, savings accounts, mortgages, and HELOCs, it's just all combined into one.
It is.
And then it makes, and then with you guys' support, clients can get education and coaching on what they can and cannot do and best practices, which is incredible.
Absolutely. And definitely. And would love the chance to talk with anyone that deems that it may be a good idea for them, right? If you're able to look through firstlienheloc.com, if you understand velocity banking well, or if you strictly budget well, or if you live below your means, or if you're someone who makes more than you spend, you don't have to make $1 million, but you do have to be diligent and disciplined with your finances. And to me, if you are, it's very black and white that this is going to be a great option, and worth looking into at least and considering, because the outcomes are so amazing. I mean, we're talking, and the hook, right, is pay off your home in 5 to 7 years. It's a hook for a reason.
Right.
It really is. Our portfolio at the bank is paying off their home at a rate of about 14% per year, which equates to about a 7.2-year payoff. The hook is there for a reason. It's not the only way to use this, but it does work if and when people budget really well, or when they live below their means. So if that is how you function, right, and you'd like to really look into something that may be able to provide some amazing outcomes for you, this could be a great one to consider.
Thanks, Anthony.
Thank you, Sebastian.